You're about to join Jerry Parker, Moritz Seibert, and Niels Larson on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Hey everyone, and welcome to another edition of the Systematic Investor series, where each week we discuss and debate what is going on in the world of rule-based investing right now. My name is Niels Larson, and I am excited to welcome back my co-host, Jerry Parker and Moritz Seibert. Good morning, guys. How are you?
Always great.
Yes,
good to
be with you.
Yes, likewise. It's certainly been an interesting week. Lots of headlines, lots of market action, lots of things for us to discuss. Obviously, the usual topics that comes up when something like this happens, a quick sell-off, and most systematic managers, lose money. So the headlines that we typically get are, CTAs did not, or trend followers did not provide any crisis alpha protection. And also they may well be part of the reason why the markets are selling off. So things like that we can certainly debate, but let's just talk a little bit about some of the return drivers for this week in sort of trend following portfolios that we run. And I'll turn to you, Moritz, probably as usual, to kick this off and just to see what's going on from your perspective.
Yeah, thanks, Niels. Well, I certainly haven't provided any crisis alpha, that's for sure. It's been a strong down week as far as I'm concerned. So down more even than the loss of the equity markets. So that's a bummer, but it is what it is. Most of the losses obviously coming, and that's not a surprise, from long positions, which were fairly large in the equity indices, predominantly NASDAQ, S&P mid-cap, Russell. Those really hurt. Lost some money from long positions in the equity, in the commodities, energies, that is, gasoline above all. And those losses weren't really countered by positions in the bond markets in this past week, at least in the portfolio that I'm looking at. So those markets have been flat, slightly down. Some have been a bit up, but like I said, real heavy losses from the equity indices.
Sure. I can certainly agree to that description. The same picture in our case, mainly driven by equities, and of course, when things like that happen, as a trend follower, at least in our case, we've made some reductions to those positions in the portfolio. And but as well, not just equities this week, energies, and also actually we gave back some money in U.S. fixed income, even though they have been the best performer so far this year. In our case, we certainly saw some losses during the week. The rest of the portfolio pretty small compared to what happened in those three sectors. I know, Jerry, you don't necessarily look at these things every single day, but were there some highlights that you might have noticed, maybe from single stocks or something else that was going on your side?
Well, like I've said before, we trade a pretty diverse group of stocks, so we haven't really participated in the profit that like the S&P has produced recently. So that's the downside. So the upside is we came in sort of long and short a lot of stocks, and we lost money in the stocks, but it didn't feel a lot like February, where we were maybe more committed on the long side. So it was really a benefit to have that diversification today, this week, So we just saw a little sell-off in the technology, and some of the shorts kicked in and helped us a little this week. It was a rally in the metals and had hurt a little. The dollar showed some weakness Wednesday, Thursday, I guess. So yeah, it was just nothing helping. One of the best favorited tweets this week was something about diversification and how wonderful it is. So we have our diversification, and it contributed to losses this week.
Yeah. No, absolutely. And I think that's, you mentioned February, and I think a lot of investors will sit back, looking at the portfolios, at the end of Friday or maybe Monday morning, and there will be some similarities, in my opinion, to what happened in February. And it's some of the same headlines that I've noticed in the last 24, 48 hours that are re-emerging. Two observations about that. I agree with you. I think we as well were more diversified to some extent, even though it hurt a lot this week, for sure, no doubt. But there were more diversification in the equity sector, and we're short a couple of the European markets already. Not much, so it didn't help a lot, but it's better than being fully long, like I think most people were back in February. So similarities and a little bit difference. I remember how a lot of people were screaming about managers, getting, reduce their exposure in February. So because this could be the big crash and so on and so forth. And of course, what we saw was indeed that the markets went on to make, entirely new highs. I'm not saying that that's going to happen again this time, but it is just that when we sit in it, it feels very different, and you're tempted to just say, oh, I want to get out of all these risky positions. But again, where the systematic approach comes well into play, in my opinion, and certainly as another diversifier. I think this is what people sometimes forget. We talk about diversification in terms of the markets we trade and the time frames and so on and so forth. But the whole process, the whole idea of not having any emotions and following rules, that's another level of diversification, in my opinion, compared to or especially if it's added to a portfolio where there are clearly people making decisions using, either a discretionary approach or certainly based on emotions. So calm collectedness, as usual, from this part of the industry is always a good thing when you go through periods like this. But let's dig a little bit deeper. I don't necessarily think that any of us saw any position changes per se. I think it was more reductions here and there in positions, but correct me if I'm wrong based on the way you guys trade. But let's jump into some of these articles, and we've got lots of questions, of course, on a day like this. So lots of things to talk about, but anything you want to say to set the stage on this, anything, or do you just want to jump into questions and tweets from Jerry?
Maybe one thing about the emotion. Yes, emotionless trading and following the rules, that is what happened in the past week. But as far as I'm concerned, there were like 2 successive real large down days, and you go like, come on, really?
Yeah.
So it's.
No, I didn't say that. I didn't say it's easy. I'm just saying exactly. We have no emotions in our process.
And then you go like, certainly it has led to a reduction in positions, not per se a change in positions in terms of direction, but certainly a significant reduction in the leverage that's traded. And you go like, well, reducing the leverage now, maybe the thing is going to bounce back and going to lose out on the upside, leaving all those profits on the table. But, well, like you said, who knows what's going to happen next week? It could be down another few percent. It's the process,
right? Yeah, it's the process, and you're absolutely right. Last time, it all bounced back, and had you not done what trend followers tend to do, which is react to the changes in price and therefore reduce when that is warranted, then it may have been a stronger year for the industry, but that's not what our investors are paying for us to do. They're paying us to follow a process, which I know we all do 100%. And so that's important. Jerry, you may have had some interesting reactions in the Twitter world this week. What seems to be popular in that sphere when you were tweeting?
Yes, had a good week on the Twitter front. Always get a lot of positivity if I stick to what people are interested in, believe it or not, which is what we do, trends and diversification and the benefits of such. And I had a tweet this week that was surprisingly was the most popular. And maybe I'm just surprised that it probably came from people who are like the three of us who like to trade and who trade for clients. And in a week like this, following the process, which is going to work over a long period of time, but possibly not work in the short term. Case in point, they hear it from the clients. And so we have this little group, this camaraderie with all of the people out there who are like us, who trade for other people and have to hear the criticism or the questioning of, do you know what the hell you're doing? And so one of the tweets this week was me retweeting a friend of mine and saying, I prefer the clients who understand that they really don't understand how to trade these markets. So I got tons of love from that tweet. And so I'm thinking, oh, that's a lot of good clients, right? Oh, probably not. Probably people just like the three of us. Although that tweet did get favorited by two of my largest clients this week. So one of these guys has been a client for a while, and whenever I talk to him on the phone or in person, I start to explain recent performance, and he'll cut me off and say, stop, just tell me you are continuing to follow the systems. That's all I want to hear. Yeah. So that's a really good client. But it does get a little insulting, or, for 35 years for me, to always be questioned. Do you know what you're doing? Can't you improve? Why don't you use the VIX? All kinds of things, which I think I have an open mind and I take seriously and say, yeah, you're probably right. But you do get a tinge of, maybe I could do it better than you, from people who don't have to live through the markets and haven't been part of the systematic trading community for many years.
Yeah, I agree with that. I mean, I agree that there is that there can very easily be this sense of, oh, this is disappointing, but it shouldn't be, because if you really understand how these systems work, you know that, especially when most of the trends has really been concentrated around equities for a while now. So you know that all the systems will be long, and therefore in a period like this, we're certainly not going to provide any form of negative correlation to traditional asset classes or equities in particular. And so it can be a little bit surprising that people feel that they are surprised that when something like that happens, like this week, that the performance is as is. That is. But I also get a lot of good comments from people who say, yeah, sure, it hurt a bit, but we understand why, and those are the greatest clients to have, for sure. And of course, you, Moritz, you're lucky. You have one big client. Any other interesting tweets that you saw reactions to from your side, Jerry?
Well, I like it seems to me that I'm not alone when I sort of express some skepticism about big data, which is sort of the opposite of what we do. We take the price trends, historical prices only, and follow the trends. Maybe we look at volume or some other things, but it's pretty much going to be driven by the prices and the trends. And it seems that people are, at least my followers, are very skeptical of big data being able to come in and do better than trend. So I got a lot of like from this tweet. It was a quote from an article. They have a mindset that we're going to conquer the world with big data. In finance, though, the market regime is not static, and markets aren't closed systems like a chess game. You can have one little pin drop that can basically make you lose over 20 years of returns. Now, I don't know about that last sentence, but it is nice to see that that people are skeptical of and understand and realize that it's really two different things. The markets are very unique, and what has worked maybe in other areas of life with big data and AI and machine learning may not work with the markets. And of course, a week or two ago, we talked about one of my favorites was my own brilliant tweet about maybe something like maybe the final step of a decision-making process of AI would be wait for the breakout. And I think I recommend that highly for almost any anything less than what we do, pay attention only to prices, regardless of how you make your decisions. You may want to have that last step. Let's just wait for the breakout to confirm it all. Yeah.
Well, I think we saw that in a couple of interesting ways. Once we talked last week, I think it was, about the interview with Stanley Druckenmiller and how he was describing his process, and that was exactly what it was. You build a thesis, you wait for the momentum, and once it's clear, you pile in. So certainly sounded trend following-ish to me. The other thing that you mentioned about AI, I heard a podcast this week on my way back from the US. I was listening to a podcast, and I forget his name, but he was someone who had done a lot of work on AI stuff, but he was also a trend follower as well. And I think his firm did trend following and mean reversion as a kind of a supplement or complement. But he said all the research that they had done, that there was no evidence that AI would help a trend type trading methodology because there's simply not enough trades to analyze. He said maybe a short-term high-frequency system might produce enough data to make some kind of improvement using AI, but he was pretty convinced that what we do, there's not a lot of benefit from that. And to be frank, I mean, I haven't interviewed many people on the podcast regarding AI, but I've interviewed a few, and some of them I think have been struggling a lot in recent years, and others I would say they may be using AI, but it's not that their performance is anything better than trend following without AI. So I have not seen any evidence myself. Now we don't know, of course, what some of these big quant funds are doing, and I have a feeling that they use much shorter time frames as well. So they may well be using it. And of course, there may be some people out there who've found a way to make it work. I'm not suggesting that, but I generally agree with your sentiment, Jerry, on that. What about you, Moritz? Have you spent any time looking at this?
Yeah, and there's a couple of things I know and a couple of things I don't know. I think the most important thing I do know is that I'm certainly not smart enough to work with machine learning. And the other thing I know is that it is certainly too early to make a judgment on the quality of that. I do have my reservations. I kind of sit with, on Jerry's side there, I'm skeptical that it can produce those magical returns. And looking at the track records of the AI funds, which we can see, and there aren't that many, and they aren't very long, right? The observation there is that the returns haven't been that great. Now, it could very well be that some of those track records are hidden from us, and we can see them because they're traded by prop shops in very short-term time frames, and maybe they're doing great things there, and then we just don't know. So I just take on the role of a patient observer. You have all those amazingly smart people going into that space. Maybe it's a bit hyped up, sometimes feels that way by the things that you read about it. And as with everything, just let the data speak, right? I guess it'll be a few years, and then also investors will come out and say, hey, can you really show me the alpha that you have provided using such and such technique that nobody can really understand but you? And is that really that much better than, proven rules? I mean, look, there are these rules that work since ages, and I like to rely on them. And, it's very difficult for me to kick this all overboard and, go to a different ballpark here and then do something else. And like I said, I just don't. I wouldn't know how to do it. So,
yeah, no, that's fair enough. I do want to add one thing, by the way. When we talked about the markets before, I try to also put it in the perspective of a kind of a non-biased way of measuring the trendiness of the markets, which is this trend barometer that I publish every day, because it takes out whether our individual systems are good or bad. It just is a measure of trendiness, and actually that hit it's not the lowest point that I've ever seen, but it hit 20, which is really, really low, and definitely suggesting that trend followers should not be making money, which I'm sure nobody did last week. So I just want to mention that. I also want to mention another thing, which I think is important, because there are clearly some managers who, sell themselves on delivering protection. I mean, so I think it's important for people who listen to this to understand that trend followers, we may often provide protection over the long run if there is a bigger crisis, but there are some managers, and this is maybe where it can be a little bit confusing looking from the outside. There are managers who will say and hopefully do deliver that they can deliver, crisis alpha even when it's on a very short-term time frame, and they obviously hopefully will have made some money for their clients in the last week or so, but it's not what we do. The three of us, we are much more medium to long term in our approach. So just to keep that in mind. I don't know if there are more tweets that you picked up in your stream, Jerry, but there was one. I don't know if it's from this week or before, but we talked about it just before going on air here. And this was this thing about indiscriminate, selling. And I think that's the other theme that I picked up this week, and that is that our industry, we're often blamed for, forcing these corrections. And I have my own opinion about that. But was there someone from JP Morgan suggesting that as well? Was that correctly understood?
Yeah, there were multiple sources sort of blaming some of the sell-off on volatility targeting CTAs. There are CTAs out there who have promised to reduce positions, keep the volatility in a certain target, I suppose. We don't really know for sure. It's hard to say who's responsible, or if we should even be upset that someone is responsible. We're
right, sure.
living in free countries with, I guess we can do smart trades and dumb trades. And it's, and I'm sure it didn't help their performance to try to liquidate stock exposure in such an illiquid time. I do think that that is really the bottom line, is what do you do when you have 1,000 S&Ps to sell and the bid is 50 or 10? And this is what happens when the craziness is that the market makers, the short-term people who provide liquidity, they step away. And if you still try to sell those 1,500 S&Ps, there's nothing there. It doesn't matter how much AUM you have. It doesn't matter what percentage of the market you are. These are all red herrings used to confuse people. I have 500 S&Ps to sell in order to get my vol down where I need to be, and there's really little to nothing on the bid. What do I do? And so that's the question. What did you do? And but this is probably mostly done, according to this same person at JP Morgan. Maybe we're 70% done with the CTAs. Hard to say.
Yeah, I think it raises two important points. The first one is, we don't really want to blame anyone, because it's you have an approach, and if that approach means that you have to reduce your exposure, that's perfectly fine. Whether it's happening now or whether it's happening much further down after the markets are selling off more, that's where I think also people blame trend followers. But anyway, leave that for a moment. I wanted to ask you a little bit and hear both of your opinion. Just going back to the fact that there is 10, we talk about there's 10 lots on the bid and people want to sell 1,000. Electronic trading. I mean, back in the old days when we were doing this, open outcry, to me, it seems to me that back then in these situations, there were a bit more liquidity. And you could sort of sense it more in the market. Nowadays, electronically, when you just look at the screen, there seems to be very little liquidity, meaning it's all hidden or it's not showing up on the screen. Well, what do you remember the difference? Have you noticed any difference? And is the discussion a much broader discussion, not just about some managers, and we talk about managers, but it could be anyone who wanted to reduce some exposure the last couple of days, right? It doesn't have to be anything to do really with the CTAs or systematic traders or whatever. But just in general, when these things happen, and maybe Jerry, you might want to kick this off from your experience. I mean, do you think there is a difference with liquidity in these situations between the electronic trading we do today and back in the day when it was all open outcry?
Yes. Well, first I want to say to agree. It could be anybody. We don't know. We just know that there are some people who've promised that they will be in there.
Oh, yeah. Yeah. CTAs will be part of it. I agree.
And then, yeah. And so others might write papers about risk parity and say it couldn't be, it wasn't us. We really haven't heard from large CTAs. But I don't really know that it's much different. I think that obviously today they have more technology to allow them to be right, that now is a good time to step aside and go, and we're not in the market for a while, we'll come back, but not right now. I do think that part of AI or machine learning could also be, we know how to set this off. We can start this wildfire and then we'll step away. So I would not discount that as well. These are very smart people. And we have also been on record as this is how we trade, this is where we're going to trade. We're going to not be run out of these positions unless it's a big break. And so we are giving them a lot of intelligence, not that they need it, but maybe that's the problem with, or the real benefit of AI is that they're playing us, not big data and lots of markets, lots of data from the markets around the world, but we're taking advantage of knowing when these we can get the CTAs to start doing a lot of trading when there's very little liquidity. So, not to be a conspiracy theorist, but
Well, I mean, if you take it to the nth degree, Jerry, CTAs don't start a sell-off. We can agree on that because there's nothing in our systems that would suggest that the trend is going up and suddenly you want to sell a big chunk. That's very unlikely, right? We react to whatever happens, whether that's increased volatility or a price turn, sure. So I think so I think it's an interesting theory about who really starts these things. But I think maybe we go back to one of your first comments, and that is, does it really matter? I mean, the markets are the markets, and having a 2 or 3% down day is not unusual. It's just that we haven't had many of them in the last few years. We've forgotten how it really is. But in the old days, 2 or 3% market moves were normal. So maybe we need to just, reset our memories a bit and get used to a different environment altogether, where this is, a normal day in the office. Any views?
Normal day in the office. I agree. I'll just add, I'm pretty sure there are systems out there that are forced sellers at the settlement, at the close of the market, regardless of how many lots you can find there on the bid. If there's 50 lots on the bid, they'll hit the bid with 500 because that's what their system is programmed to do, right? It doesn't make a difference. But I'm not really following, micro market structure and all those type of things. I've read on Twitter also that I think on Friday or Thursday was one of the most liquid days on the NASDAQ futures, on the NASDAQ E-minis, whereas previously, like pretty much for all of this year from that same source, which by the way is Nanex, I think a Chicago-based firm that looks at trading volume, among other things. They've reported that, markets have become less and less liquid, and that you see, algos, working the different levels of the order book, but only in small sizes. And every time the market makes a larger turn, then that size vanishes and is no longer there, right? And that may have been true. I'd also periodically review slippage numbers, and haven't done that in a while, but those could give hints about the behavior of the order book and whether you can get the size done that you used to get done for a certain amount of slippage, and how that slippage has developed over the past couple of months.
It's one of the benefits that we had as learning how to trade in 1983 from Richard Dennis, is that as good as they were with computers and math and back testing, and Rich came from the floor. And so it was this ability to combine what's possible on the floor with the systems in the technical system computer approach. And probably that gets lost on men and women who come from PhDs and from universities or finance, having never dealt with the markets before. They would, yes, say, okay, just the computer's right, sell, because it's always worked in the past. Well, what's going on today in market structure is not the past. So I think that's indiscriminate selling. I mean, Moritz defined it right then and there. And that's what I think is unfortunate. When I traded $2 billion AUM, $2.5 billion, I was still in cocoa and bean oil. I would just tell the broker, just buy 5 lots every 30 minutes, or, and take a week to do the trade, build my position that I wanted in these illiquid markets. I never said, well, I got the signal on Monday, we got to get it done on Monday, regardless of what reality was. And so the positive about this is not helping anyone who has an idea of slam it. And we have to be a slave to the numbers and what the back test says.
Yeah, no, I agree. I agree with that. And actually, I think it's one point that we tend, the three of us, at least in our conversation, tend not to talk much about. But of course, the mutual fund industry with its trillions of dollars, et cetera, and they have all these buy programs and sell programs at the end of the day. And I certainly wouldn't be surprised if they can move the market significantly as well, which has absolutely nothing to do with the alternative industry whatsoever. Now, jump in with anything.
Maybe one thing I want to add there is, and I think Jerry just mentioned that, like in the old days when you had an order and maybe that order was worked over a period of time, right? I still think so. In my personal trading, I'm not sending, I'm not, placing orders through a machine automatically. It's still, pretty much done in the old school way of, orders are being produced and they're sent to a broker, and brokers differ. Like, if you have a good broker that understands the way you trade, right? Understands what you're looking to do with those orders. As far as I'm concerned, that really helps.
Yeah. And we have the same opinion on our side. We don't let the machines go directly to the exchange. There's definitely a human being involved in deciding how that should be executed. And I think that makes a lot of sense. But of course, there are a lot of systems that go straight to the exchange, and maybe that can add, some extra volatility here and there. But again, I think sometimes these things are blown up a little bit, and especially if people like JP Morgan are coming out saying this. I mean, I think they have I think quarterly accounts where they pride themselves of having 90 days of the last quarter we didn't lose any money. I'm just thinking, okay, so how does that work if you never lose any money? So they must have some very interesting insights. But anyways, we've got a lot of questions that I wanted to tackle. One of them came a couple of weeks ago from Mohit, and I emailed with you today, Mohit. So I know you were expecting something, but because your question is rather long, it relates to moving averages and it's so on and so forth. Because there's a lot of things happening right now this week, I'm going to delay that further. Apologize about that, but we are going to try and get through to some of the shorter questions today and get a few more of them answered. But I have not forgotten you. Anyway, here's a question from Raphael. He talks about something that was mentioned in episode 3. And he says, if the optimal to have around 50%, so this must be a comment that we made, and I think maybe it was you, Moritz, or maybe you, Jerry. It says, if it is optimal to have around 50% of your portfolio in CTA, Systematic Investor Podcast, episode 3, what is the optimal remaining allocation? So Anyone who wants to venture into answering this?
Oh, that's a great one.
Yeah.
I remember where that comment came up and why it came up. I think we spoke about the optimal allocation of trend following within a diversified portfolio, say 60-40 portfolio or something like that. And we spoke about maybe allocating 10% to trend following managers and concluded that, well, if you've allocated 10%, then really that doesn't move the needle that much, right? So I was saying, well, if you want to get the benefits of a trend following allocation, the diversification, all those type of things, then probably you want to look at a 50% allocation or higher. Now, to your question, I think, why don't people start with trend following? Why isn't that the base allocation? So make it 100 if you want, right? And if you still must add other things, long only equity, credit, I don't know, then do that. But maybe do it from the kind of like in reverse. Start with trend following, make that the base, and then see how much you want to reduce that, right? And add other things. Whereas most people go the other way around.
Right. And
so
you may have some...
needless to say, my perfect allocation to trend following is, for me, greater than 50%.
Sure. And of course, you might have something to add here as well, Jerry. I just wanted to say one thing in general to this question, and that is what I suggest when people ask me, how to build a portfolio. It's not so much that I'm focused on whether it's 50% trend following, et cetera, et cetera. I just think the idea of having uncorrelated assets in your portfolio makes a lot of sense. And your research will tell you how much of each of these assets will be quote unquote optimal, but whether it's 40%, 50%, it depends. But obviously uncorrelated assets, including stocks and bonds, will be some of those remaining parts in a portfolio, in my opinion. Any views on your side, Jerry, or do you agree with?
I agree with what you just said. You, trying to get to the bottom of this in a short amount of time is difficult. We're just coming from a very defensive point of view, where golly, 60-40 plus a little bit of mostly bonds, mostly stocks, mostly bonds, and a 5% of trend following, then we're like, well, that doesn't sound optimal from our point of view. I think that something else I said recently is to make it more complex would be, let me trend follow your stocks, your 50, 60% of stocks, and that can really add some crisis alpha to that.
Sure.
I think what happens with the unique situation of probably the only market, or maybe bonds, but definitely stocks, everyone kind of acknowledges that it's in 20 years, their stocks will probably be higher. It's probably the only market that has demonstrated, at least historically, that buy and hold kind of works. So it's a complement to trend following currencies, commodities, stocks and bonds, long and short, CTAs, trend following portfolios. It's a complement to that because we don't have any trades or positions that are long only all the time. So there is some trend following fails big time over the past, you can see it in the data where stocks crash, we get out, we implement our trend following on our stocks and all the other markets as well. And yet they just go right back to the highs. Maybe we got out, we got short. It just can get really bad. And then all the equity indices rally again. So that feature of never getting out, long only, yes, you're going to have 2008, which is going to drag performance down, but so often it just really works well with something with trend following, even if it's long term, that's going to have a different return pattern. So throwing that in, I would say 20 or 30% as long S&P probably would add some welcome diversification to a portfolio. Now that assumes stocks are going to continue to have that feature, which I'm sure they will. It's kind of funny that we don't put that into our systems. I guess so. Maybe I don't really believe that, but I do think it's a complex problem. But just as you stated, what's going to give me, let's look at all the numbers and let's don't even put names on the markets. Let's put numbers on the markets.
Yeah.
Run our analysis of correlation returns, and see what that portfolio looks like. And I think it would be a lot of commodities and a fair amount of stocks and currencies and commodities. And I don't know where it would come down, but it would be far more than 5 or 10% for CTA trend following.
Sure. No, I agree. Moving swiftly along, we got a long question here, 3-part question from Dave in Minneapolis. And the first question actually is for me, and it's a little bit relating to the trend barometer and the 44 markets it track. And you ask, Dave, whether I could discuss the components inside it. To be perfectly honest, I don't recall all the components inside it, but I do remember that it's developed, and this was developed many years ago. There are different momentum indicators inside the trend barometer, just to give a general feel for the trendiness of the markets in a diversified portfolio. And it just so happens that I've not come across anything that seems to track the environment as well as this does. But I'm sorry, I can't really give you the detailed answer you were asking. But the next question you have, maybe we can help you. It's for Moritz, at least to begin with, and I'm sure it'll translate into you, Jerry. It says here, Moritz, you mentioned a couple of times that, and he's paraphrasing, over the past week, I haven't made any changes to position size. If you're willing to share this information, are you implying that while you are in a trade, you may add to a position based on some measure of volatility, for example? I realized that the turtle had rules to add to their initial positions, and would love to hear you discuss whether adding to an existing position is something that is still commonly done. So maybe Moritz, you want to talk a little bit about it, and Jared, if you want to add anything.
Yeah, from what I understood, I mean, the way that I like to do that is to take a position, and at the time of position entry, that position will get a certain size. As far as I'm concerned, that's a function of historical volatility or average true range, right? And then over time, that position may develop. For instance, say you have a long position initiated, and you may add to that long position because the market continues to make new highs, as one example, right? And again, when those new signals are hit, again, there's a position size calculated, and ideally I'd like to just, keep that size on until the trade hits a stop. Now what that then does is that I don't have any of that vol controlling taking place in between, which is kind of like, that their overlay to the system that doesn't really have to do anything with the pure trend following part of it, if you see what I mean, right? Now, that being said, there is a larger bracket around the entire portfolio, so that, if there are very, very large moves, the magnitude as we have seen in the past week, certain risk management rules kick in, and that may have an impact on position sizing.
Sure. Anything from your side, Jerry, since Dave was referring to the turtle rules?
I agree that with Moritz, it's basically a portfolio overlay vol targeting type of idea. But I like to put the trade on, risk 50 basis points, hold on to it for a year or two, and do nothing with it. Never change that position for any reason. And that's the system trade. Now, the volatility may get way more than 50 basis points, 200, 300, 400 basis points up and down, way more than 50 basis points from the high, from the max profit. So I would just define my risk as the initial potential loss of the 50 basis points of capital, and not anything going on prior to the exit criteria being hit. Old school, classical, old-fashioned trend following.
Sure. Sure. Excellent. Very insightful. I'm going to jump to I think this will be the last one because we do want to try and keep these sessions to about 45 minutes, and maybe one day we'll do a full Q&A. If you come up with, and I'm talking to the audience now, if you come up with a lot of great questions, maybe we will do a special episode, pure Q&A to satisfy all of that, which we would be delighted to do. But let me ask, here's one that came to your Twitter account, Jerry. Jerry talked about being flat in a recent episode. Can you elaborate on when a trend follower would be flat and for how long? So maybe you want to pick up on that, Jerry?
Sure. I mean, I think that when you analyze the markets and do back testing, you'll probably see that one of the better ways to set up your system would be to have the entry and exit parameters be different, and maybe the larger number would be the entry. So maybe we'll buy the 50-day breakout, we'll go long at the 50-day breakout, and then we'll get out at the 25-day low. Now that's too short term, so don't do that. But this will obviously produce some short trades, some flat trades, sorry. And
sure.
So I think this is just a result of doing a back test and seeing that, oh, okay, I see. The entry should be a little bit higher number than the exit. That's what the optimal portfolio or trading system might look like. And, sometimes just in eyeballing the charts, you can say, oh, definitely a long trade. Oh, definitely a short trade. That's not really moving too much. So even intuitively, it makes sense before you do the back test that, yeah, it's perfectly fine to be flat. Hard to say how long you would be flat. It's not really an issue or a problem. It's just what most people have gravitated towards.
Yeah, no, that's right. So essentially, it's the neutral zone that happens when you use price breakout methodology. There's always going to be a zone where you neither hit the upside breakout or the downside stop or breakout. So yeah, absolutely. I'm going to take one last quick question here. And that is from Mohit again. So I delayed your other question, Mohit, but you did come up with another one today, which I'll just quickly ask. He said, would it be possible for you and your guest to be talking about your worst trade ever and when you're following the systems? I wanted to hear about the psychology of going through an unprofitable decision. So I think the answer will probably be relatively short from both of you. So I wanted to see if we can also just provide a quick answer to Mohit, since he has been patiently waiting for another question he was asking. So worst trade, Moritz, I mean, I know you probably don't think about it like that, so maybe you can just quickly describe how that concept works.
Worst trades probably being the trades where you don't follow the system, where you don't follow the rules. We spoke about that, I think, in episode 1 or 2, where, I remember saying that most of the time I don't follow the rules. That doesn't end well. All right. There are exceptions to that, but certainly as far as trend following trading systems are concerned, not following the rules, in my case, has led to bad performance. So every time that happens, that's bad. But apart from that, really, sure. I mean, in that portfolio, there have been trades that have lost a tremendous amount of money. Is that a bad trade? No. Well, it's a trade that has lost money, but the trade was a good trade to take at the outset when that signal was generated. So it's one of many, one of a very large sample size, and that distribution of results includes trades which are painful and losing a lot of money, but they also include a lot of trades that are just beautiful. So it's very hard for me to really pinpoint to that one market or that one trade where in that trend following system, I would say that was really the worst trade I've ever made. It just, sure. I don't see it and look at it that way. Sure.
I'm sure you have a pretty similar answer, Jerry, on that side.
I do, and I agree with Moritz on all of that. I think the missing a trade is by far, so missing a trade is the worst trade. Yeah. And that's why it's very important to not miss a big trend with a trend following style. In 1992, I got caught short in interest rates, UK interest rates and stocks, the FTSE short. It was a surprise in the election, and I had to get up at 2 o'clock in the morning, 3 o'clock Eastern time, and go in and unwind those trades. And I had had a few phone calls from people who said, you know what's going to happen if this election doesn't go the way that it's planned? You could have a huge, I was like, oh my gosh. And so that was kind of like, I remember pulling into my driveway at 3 or 4 o'clock in the morning saying, don't be so wimpy. So you're down 5% in one day. You did all the right trades. Don't let this affect you. And I think we ended up making money for the month. So sometimes the pressure from others and outsiders, it was so obvious that this was a possibility. But then Brexit, we crushed it on Brexit.
Sure. Yeah.
And so it may take a while for you to get that money back from a specific market, which is probably a psychological problem you should not even think about. But I think we're just always bombarded. Once again, we're back to this whole thing. If you want to improve your performance of your CTA, love your CTA. I actually had a call in February from a client just saying, hey, I have no idea what's going on today, but I know you're probably losing lots of money. You're wonderful. Keep going. That's the sort of environment I grew up in the Turtle program, where the bottom line was do the right thing, do the hard thing, follow the system, and that defines your good and bad trades.
Jerry made an excellent point there on missing a trade, right? There's a real gentleman I like listening to, Tom Basso, another great trend following trader. And he once gave that example of having missed a trade, and the trade that he missed, or that's many moons ago, that was the trade that would have, kept his portfolio stable or slightly profitable for the year. And he missed the trade because his parents came over for a week, to visit him, and he wanted to spend time with them.
It was a silver trade.
Maybe it was a silver trade. I forgot the market, but it's such a great example, right? Because it really could, in the way that we trade, it could be that one trade. It doesn't have to be 10 trades. It could be just one trade or two trades that define and make the difference between a good year and a positive year or a negative year. And that's just because our distribution of P&Ls is so skewed, right? There are many.
There's almost nothing that you can do, no matter how smart you are, to improve your systems to the degree that a huge monster trend won't be better. And it's very humbling that we're held hostage by these trends in these markets. But there are people out there who can probably tell us of the money that they've made, having not nearly the opportunities we've had to learn from others and to work for organizations that had the capability to do fantastic back testing. And I think their testimony would be, I just crushed it. I always did the trades. And this 200, 300 ATR profit I had back in 19 whatever really made up for a lot of my inadequacies. And that's what, that's the markets are the heroes, and we're hostage to these markets. And now they haven't been trending for a while, but they'll all come back and will be proven correct. But it is quite ironic that it's a very humbling business that when you're waiting for your profit makers to wake up and do something for you, and that's what we can't give up on.
Absolutely. The great answers to that. Before we wrap up this conversation, let me just, as usual, quickly do a rundown. These are performance numbers as of Thursday. So I think Friday was a generally a quiet day, but BTOP 50 index down for the month, 1.67, down 4.22 for the year. SocGen CTA index down 2.6 for the month, down 5.97 for the year. SocGen Trend Index down 3.86 for the month, down 6.93 for the year. And finally, the SocGen Short-Term Traders Index down 0.66 for the month, and down 0.28 for the year. So on that note, we're going to wrap up this week's conversation. We hope that you have enjoyed it just as much as we enjoy making them for you. And if you felt that you got something from them, then please share and leave us a rating and review in iTunes. They really do help. So from Jerry, Moritz, and me, thanks so much for listening. And we very much look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.